Friends, greetings to you all. Yesterday, we came to the conclusion that there is still no reason to close the long positions we opened on July 8th. Over the past 24 hours, the market has provided new data, and today we need to answer just one question. Has anything at all appeared that would make us reconsider yesterday's decision? Let's start with the big picture, AVG. Let's switch to the daily time frame. Let's select a depth of 60%. It is at this depth that you can see where large capital, market makers, and their algorithms begin to change their behavior. If you look at the data, you will see that over the past 7 years, this situation has occurred on just 3 occasions. And most importantly, not to dwell on each case in detail, what matters is something else. Each time after such an anomaly appeared, the market entered a growth phase. The first case was in 2020 during the coronavirus pandemic, after which the market grew by 1,000%. The second case was at the end of the first wave of the alt season, and Bitcoin grew again by 120%. And the third case was at the bottom of the bear market, when Bitcoin grew more than 5-fold. And the last time it was more than a 5-fold increase. Pay attention, in all 4 cases, the market's subsequent path was different. Sometimes at first, there was a prolonged sideways movement, as was the case in 2022 and into 2023. Sometimes the market punished those who opened positions too early. Again, this is confirmation of what happened with Bitcoin when there was a second bottom as a gift, so to speak. Sometimes it seemed like the scenario had stopped working altogether, and that was also due to prolonged sideways movements. But the outcome remained the same. The global trend continued to develop. That's why right now I'm not interested in how similar the chart patterns look. I'm interested in whether the underlying market structure itself has changed. So far, I don't see that happening. And by the way, if we pay attention, we are also at these levels now, and there is a huge potential for upward movement. When should you exit the market? Well, at the very least, when the AVG reaches its upper boundaries, that is, the upper part of the channel. But that won't happen soon, and as for what the values will be, honestly, I can't even imagine. There is one more detail. When the market was forming a bottom in 2022, the volumes were initially small. Let me add the volumes to the chart now. I've added the volumes to the chart. And look, when the bottom was set in 2022, that is, right here, when the anomaly appeared, the volumes were still small. And only in the sideways range did the volumes start to increase, just like they did here. By the way, in this sideways range, we made a new low, and only after that did a full-fledged movement begin. Right now, we're also not seeing any extreme volumes yet. That's why we can't rule out a similar scenario to 2022 with a new low and a shakeout of proper longs. But the main point here is very simple. So far, this metric fully confirms the long-term trend, the scenario of growth. Of course, this single metric alone is not enough. If the next indicators show a different picture, my opinion will change. So let's continue our analysis. Let's take a closer look at the difference between limit buy and sell orders at a 60% depth. And we'll also examine these specific trends all the way back to 2019. And here the picture also looks very interesting. As you can clearly observe, right now, there are once again significantly more limit buy orders than sell orders currently present. This means we have a very large zone where major institutional capital is interested. We have already seen a similar situation before, including in 2019. After that, the market grew significantly. This happened within this range. We observed a similar situation in 2020, after the corona dump and during it, and in 2021, when the first bull season ended, and before the rebound in 2022, as well as at the bottom of the bear market in 2022 to 2023, and now. And right now, I'm not comparing the price, I'm comparing the market structure. The structure today looks almost exactly the same as it did during those periods. If we overlay this situation onto 2022, the similarity becomes even more apparent. Now I'll take a closer look at the chart and show you. First, the market bounces around within this range. Then there's a downward trend, after which a brand new growth phase begins. This doesn't mean that history will repeat itself exactly, but for now, the structure remains very similar. And now here's what's happening. We also observe a wave of significant growth, then a subsequent decline. Again, there is another brief wave of growth. So far. And after some time, the price is then driven much higher. Yes, this could happen through a sideways movement, it could happen immediately, or it could happen after a new low. But the fact that the price will rise is not in question. The only question is when it will rise. The fact that it will rise is no longer in doubt. There's another interesting detail. During the previous cycle, the market only started to show a significant turnaround globally, after the DIFF finally managed to reach the zero mark. Let me mark on the chart now how it happened in this situation. The market globally reached a balance, after which it went lower. Right now, we haven't reached that point yet. Those values, I mean. So if we look only at the limit metrics, there is still room for further growth. This doesn't mean the market is obliged to set a new high right now. But in my opinion, it's also too early to talk about the end of the upward movement. The first check is complete. So far, both long-term metrics confirm yesterday's hypothesis, but the long-term picture is only half of the analysis. Now, let us take a closer look at what is happening within the current market dynamics right now. The first check is complete. Both long-term metrics still confirm yesterday's hypothesis, but that is simply not enough for a full conclusion. Now let's move on to what's happening in the market right now, and let's start perhaps with altcoins. Over the past few days, I've been asked the same question quite often. Why, if I'm expecting further growth, am I currently focusing mainly on Bitcoin and Ethereum and not on altcoins? The answer is quite simple and lies in the details. If you look at previous cycles, the main movement has always happened in stages. First, money would flow into Bitcoin, then Ethereum would start to catch up, and only after that would capital gradually move into most altcoins. In my opinion, we still haven't seen a full-fledged alt season phase yet. Yes, there have been certain moments where some assets moved strongly, even right now, but it's still too early to talk about a massive capital flow shifting into altcoins. That's why my priority remains the same. First and foremost, I trade Bitcoin, and secondly, Ethereum. And only after additional confirmations appear, such as funding rates, will I start looking much more actively towards altcoins. This doesn't mean that individual coins can't show good growth. They can, but if we're talking about probabilities, then right now, in my opinion, the main opportunities for trading, positive opportunities, are in Bitcoin and Ethereum. Now let's examine whether the current market structure actually validates this. Well, let's move on to Bitcoin and take a look at the smaller timeframes. Here we can look at not just the broader global picture, but the situation we are facing right now. Let me remind you, yesterday we decided to hold the long position that we opened on July 8th in this range. Now let's see if there are any reasons to change that decision. And let's start perhaps with the limit order metrics. It was precisely these metrics that a few days ago gave us the opportunity to enter a long position. They gave us an entry point. Let me remind you where we entered the long position. It was at the intersection of the green and orange lines, that is, in the buyer's zone. The first thing that immediately catches the eye. The price has already moved quite far from the buyer's zone. This means only one thing: opening new long positions at the current prices. Even though there's a correction happening now at 63,950, I definitely wouldn't do it. Let's switch, so to speak, to the 1-minute time frame. We can see that, yes, we still haven't entered the green zone. And in general, there's no real sign of any intention to do so. Dimitri, into the green zone. This means only one thing. I'll repeat, I wouldn't open new longs at the current prices. But here, it's very important to distinguish between two different decisions. Being late to open a new position doesn't mean it's time to close an existing one. These are fundamentally different things. That's why today we're only answering one question. Are there any reasons to exit the position even though there's a correction happening now? And here, the situation looks even much more interesting than it did yesterday. During the previous approach to these levels, we saw that limit sellers started to appear quite actively here. This is clearly evident from the crossing of the lines. After that, many altcoins corrected quite sharply and deeply, but today the picture is different. The price is significantly higher. At the very least, that was the case. But nevertheless, there was absolutely no seller's zone present. There were no crossings of the green and yellow lines, which clearly indicates that we do not see a limit seller. The limit orders that usually act as a barrier to upward growth, which are later executed as market orders and put significant pressure on the price, are simply not present in the order book. They are not appearing at all. This is currently the most compelling and powerful argument in favor of maintaining the existing upward structure. And there is one more detail. A new buyer zone has once again formed above the previous one. So this is what, as I have pointed out in my previous reviews as well, but I will reiterate this point once again. The new buyer zone that appeared here did not update the low of the previous buyer zone, nor accordingly the one before that at all. In other words, we have rising lows. This is within the framework of an uptrend. This means that the major buyer continues to move their limit orders higher. As long as this is happening, it's pointless to talk about a full market reversal. In other words, until 61,000 is broken, there's no point in discussing it. By a full reversal, I mean that we would go back to 60,000 or make a new low. As long as this isn't happening, I repeat, there's no point in talking about a reversal. So the second check is complete. The limit order metrics still confirm yesterday's hypothesis, but one set of data is not enough. Now let's see if the market participants themselves are starting to overheat. This is where things get much more interesting. Now let's look at the next group of metrics. Up to this point, we have been looking at limit orders, and they fully support yesterday's hypothesis, but that's not enough. Large capital can continue to buy. At the same time, traders themselves may already be starting to overheat the market. That's exactly what we're going to look at now. So let's now turn on margin loans and see what's been happening with margin loans over the past 24 hours. This metric shows how actively margin trading participants are borrowing USDT to open new long positions. This is exactly where the first signs of overheating often appear. Take a look at what's happening right now. The volume of loans really did continue to grow yesterday. That makes sense. After a strong upward movement, more and more participants start to believe in further growth. But here it's vitally important not just to look at the fact that margin loans grew yesterday, but to fully comprehend how far the market has already gone, or exactly how leveraged it currently is at this point. Historically, I pay close attention to the area around $250 million. It is after reaching these values that the market most often starts to form local tops. There are several examples of this. You can go through the chart, but again, I won't overload you with too much technical detail. Today, the figure is significantly lower, $23 million. But it has increased. Yesterday, it was $150, even $180 million. And it has grown compared to previous days. But there is still a margin before reaching the levels after which I start looking to exit positions. Therefore, this metric does not yet make me change my decision, but it does make me a bit more cautious. The third check is complete. For now, I still don't see any reason to close the long position. However, I personally find that I like the next metric significantly less. Now let's take a closer look at the long-short account ratio, specifically margin accounts across all pairs available for margin trading at the same time. It is here that right here today a signal appears, which most definitely deserves our full attention. This metric has finally reached the levels from which corrections, serious corrections, began in previous instances, like on June 2nd. And unfortunately, even during the significant market decline that we are currently witnessing, the total number of long accounts across all types of margin loans is finally starting to show a noticeable decrease as well. This means that more and more participants are starting to lose faith in the growth. At first glance, this actually seems like a good thing. It's normal for margin traders not to believe in growth when we're at the lows. But if we look at it from another perspective, margin traders aren't necessarily the most foolish traders out there. And based on the statistical data we have gathered, when they don't want to go long, as is clearly happening right now, the market typically starts to decline. Conversely, when they are aggressively going long, so to speak, those are excellent and highly favorable opportunities to look for potential entry points. At the very least, it's worth considering entry points if there is a limit-based argument for it. That's why this metric has already reached the levels from which we've previously observed corrections. And at the very least, this tells us that as soon as the limit metrics once again reach the points where they indicate that the market has entered abnormal buyer or seller zones, in our case, of course, that would be a reason to exit the market. Let's answer the main question of today's review. Has my decision changed over the past day? No, it hasn't changed. The long position that we opened on July 8th, I continue to hold. I'm not considering any new longs from the current levels because the market hasn't even entered the buyer's zone during this correction. There aren't even any anomalies on the 1-minute time frame. A new short position, I'm also not considering because there are no reasons for a new short. Yes, no one is ruling out local pullbacks during the growth. No one is canceling them. But in order for us to talk about any full-fledged short trades and closing such serious longs that we've accumulated, there need to be substantial arguments for that. And until the market drops below 61,000, I do not plan to take the short side, and I will consider every new buyer's zone as a point, an entry point for adding to the position, for increasing it, for pyramiding the position, so to speak, yes, and moving stop losses higher and already into profit accordingly. So over the past day, the market really has changed, but not enough. Not enough to abandon my previous scenario. There is more caution now, and signals have appeared that need to be monitored. This is the ratio of long to short accounts, but overall the plan remains the same. Long positions. I hold new positions and consider adding when the price enters the buyer's zone while shorting the current ones. Ishayo in principle is not interesting to me. This is not a planned movement. It's just movement within the bounds of volatility. Tomorrow, the market will give us new data again, and we will once more test this hypothesis. Because my goal is not to guess the top or the bottom. My goal is to change my decision at the moment when the data changes and to close the position with a profit. That's exactly why tomorrow we will open these same metrics again and see whether the market confirms today's scenario or if it's time to reconsider it. Thank you for watching. If you're interested in what I'm talking about, head over to my Telegram where you can get more detailed information about the Trading Platform Pro service metrics. Subscribe to this YouTube channel. Here you can make money. That's all from me for now. See you in the next review. Thank you all. Goodbye, everyone.